Lately, we've been talking about how the S&P 500 was on a high, providing more than 25% returns for 2021.
The S&P managed to rally 27% last year.
Free money. Out of helicopters from everywhere. Free money.
But if you were to look today, they're down by 2% so far for 2022. And then don't forget about how the tech stocks, the ones that were leading the S&P 500 last year, the crypto markets and more have started to trend down too. Now take this and couple it with the fact that everyone's talking about a market crash coming soon, from Warren Buffett to the guy from The Big Short, aka Michael Burry, aka Christian Bale is who we're all picturing, and they're all warning us about it. But what actually is a market crash and why does it happen? A market crash is basically what it sounds like. After the markets, like the stock market, are doing well and are trending upwards, all of a sudden they start to tank and crash down literally fairly quickly. Now we saw this happen in March 2020, but at that time everything recouped pretty quickly for the most part. It was kind of a baby crash that really did come out of nowhere because the virus came out of nowhere. But usually market crashes aren't all of a sudden. Now they might be for the everyday person who isn't really tapped into what's going on in the economy, but there are signs that it could be coming, like we're starting to see right now. So let's jump in and start with what is happening in the markets right now.
So what's happening right now? In our last video where we talked about how the stock market performed really well in 2021, we also mentioned how Jerome Powell, who's the chair of the Federal Reserve, has basically kept the economy afloat and kept it going by printing a whole bunch of money and adding an influx of cash into the economy to keep people spending. Now, even though this has been good in some cases, it's also led to other problems like inflation rising. We've seen prices go up, and we even did a video a few months ago when everyone was slowly starting to talk about inflation fears and, prices going up. But it's interesting because in Canada, we're at almost 5%, and in the US, they're almost at 7%, and don't even get me started about Turkey. The thing about inflation is that we have to combat it. And we know inflation needs to be combated after a certain point, because if prices are rising at a higher level than people's salaries, then that becomes a major public concern. And when it becomes a major public concern, then that means the government has to put pressure on the central banks. So again, in order to combat it, interest rates are ultimately going to have to go up. High level, basically we've been in this period where there's been so much money floating around, and basically everything's just been going up in value. But what we're going to be seeing moving forward is a period of hands-on tightening. If we take a look at interest rates, we all know that they've been really low for a while now, and we've seen it in things as simple as different mortgage rates, different savings accounts rates. I know for our preferred high interest savings account with EQ Bank, the rate back in January of 2020 was 3%, but that's now 1.25%, which is kind of crazy, right? Now, basically what's going to happen is that when the central banks increase their rates, you're going to be more incentivized to keep your money at the bank as opposed to the market where you're going to earn more interest. What it typically means when we see interest rates go up is that stock valuations in the overall stock market are going to go down. But why? Why do stock prices go down when interest rates are up?
Another thing that's happening is that bonds are going up. Now, bonds are basically the opposite of stocks in the equities market. They're issued by the government and they're less risky investment. Basically, when you're buying a bond, you're loaning the government some money to fund different projects like infrastructure. Now, with bonds going up, it means that people are able to get a decent return from this less risky investment. And again, even though you're going to get less of a return than in the riskier equities market, if those rates are going up, it means that people will start to move their money there, and in turn, that means that there'll be less money in the stock market. So that's one reason that stocks could go down, but the other one has to do specifically with the ones that we're seeing go down a little bit already. And it's also the stocks that we'd expect to crash first, which is tech and growth stocks. This mostly has to do with something called a PE ratio, which means price to earnings. We're going to keep this as simple as we can for right now, but we did talk more about this concept in this video linked here. But tech stocks in particular and growth stocks in general have a high valuation because we're always considering their future value. I like to think of this like Shark Tank. If you've seen that show before, companies can come in, and if they have these innovative ideas, likely in the tech space, then they can ask for these high valuations based on the potential future return of the business. They don't really have to prove that they have equally as high current sales, they more so have to look at what their future growth rate is going to be. What this means is that if a company or a stock is claiming that they're going to be more valuable in the future than they are right now, it means that you're currently paying a premium on the price for the potential future return. So when interest rates go up and inflation is high, those stocks that are being valued based on their future worth, the ones that you're paying that premium for, are going to be worth less, because the value, once you actually adjust for that high inflation, is going to end up making you lose money in the long term. It's literally not worth paying for. Also, as a quick side note, the way that the Fed raises interest rates rates is actually by raising what's known as the federal fund rate or the overnight rate in Canada. This is the rate that banks use to borrow money from each other, and when it becomes more expensive for them to borrow money from each other, it forces them to actually raise the interest rates that it costs customers to borrow money.
Okay, so now that we've talked about what might cause the crash and what will be impacted if and when it happens, something that we haven't talked about is what you should do. So should you try and time the market by hopefully selling at its peak and then buying back in at its bottom? Honestly, the answer is a simple no, because it's been proven to be a really terrible strategy. Really, no matter how you slice it, it doesn't matter. You're not gonna be able to know whether you're in too late, whether you're in too early. You're not really gonna know, and honestly, no one else that you follow online is gonna know the exact date, the exact time of the actual crash, right? Overall, our approach and the message that we have for all of you is to make sure that your base and your core are still those passive long-term investments that you're hopefully dollar cost averaging into over time. So if you're a do-it-yourself investor, I'll throw up the different funds that we particularly like, but you can also use the same method that Steph uses where you're using a robo-advisor who automatically invests the money for you. At the end of the day, you're likely dollar cost averaging into these funds, so you'll be able to buy when the times are low, but you'll also be buying when the times are high and everywhere in between. Something that you have to remember is that historically, this method has proven to be the most successful, and honestly, the vast majority of large cap stocks underperform the total stock market. Think about it this way: what makes you invest in something? It's either because you heard it was great for long-term success, like what I just mentioned, or maybe someone told you to invest in it, so it's probably speculative and you don't know much about it, or maybe it's because you're jumping on a trend of some sort of investment that's on the rise. For those last two options, it doesn't necessarily mean that you're not knowledgeable on the investment or have long-term confidence in it, but instead you're gonna be more likely to panic sell when the market is crashing, which is, surprise, surprise, what most people do. That panic is equal to you selling off and losing money. And remember, you don't lose money when markets are low, you lose money when you sell when markets are low. For the most part, especially when we're talking about investments that you believe in for the long term, your positions will recover, and usually they'll recover at no loss. So again, what should you do? Either put your money in those broad market funds for which you're gonna be dollar cost averaging into over time, maybe month by month, or actually have some confidence in the investments that you choose yourself that don't necessarily have that historical performance of being really successful. With those ones, you'll want to feel like you believe in them long term, but also at the same time feel comfortable with potentially losing money. This means that you cannot be putting money into investments that you cannot afford to lose.
If after everything that Dennis just went over, if you do still want to invest in single stocks and crypto and NFTs and other investments too, you can, but remember, it's a good thing to have a strong portion of your portfolio in these broad market funds. And also, if you're going to be investing in those other more riskier investments too, just make sure that you're both comfortable with the reward, but also the risk that comes along with it. The last thing we want to mention is that market crashes do typically mean that it's a horrible economic environment going on, and it can leave a lot of people struggling, which is never a good thing. But at the same time, it can be a good opportunity for investors that are ready and have cash available to actually go ahead and make a lot of money at this time too. It's basically what people are talking about when you hear them say buy the dip. If you have the cash available and if stocks are at a low price right now, and you believe that they'll go up in the long term, and this goes for stocks and funds, then you can basically buy them on sale and then make a lot of money when the prices do go up. Now we're going to dive a lot more into this topic of buying the dip during market crashes and our plans for when one eventually does come up in this week's quick takes video, so make sure you keep your eyes out for that.
Alright guys, so that's a wrap on this video. Hopefully you guys enjoyed it, and hopefully we gave you a good gist of what a market crash is and what it actually means for you. Later this week in our quick takes, we're going to be going over our thoughts and our plans for the up and coming market crash, whenever that's going to be. But yeah, if you guys haven't also already looked at our description box, we do have our investment links for those of you who haven't already gotten started with Wealthsimple and Question. So make sure you guys check those out. As usual, if you haven't already shown us some love, make sure you show us some love down below with a like. And if you haven't already subscribed, subscribe right there in the corner. And if you haven't already seen any of our previous videos, make sure you check them out next door. We will be back. You know the vibes. Let's go.